Dennis is up here already, as you can see. He's ready to go. Onward with normalization, the Fed in the middle of the rate hike cycle. Dennis is here to talk about that. He is president and CEO, or former CEO at the Federal Reserve Bank of Atlanta. Dennis, it's all yours.
Steve, thank you very much, and good morning, everyone. If I were to give my remarks this morning a title, it would be The Great Unwinding. Now, central bankers and even former central bankers are not prone to exaggeration. But I do think the circumstances of the last 10 to 11 years and the extraordinary policy that was applied to the financial crisis, the recession, and then a very slow recovery were of the magnitude that justifies me calling it the Great Unraveling. Now that's a little bit US-centric. The European Central Bank has announced, but not yet begun, their process of tapering quantitative easing. So my remarks will be focused largely on the United States, but keep in mind that title, The Great Unwinding. What were the circumstances that gave rise to the extraordinary policy that is now being unwound? I can look in this audience and see that many of you were perhaps in university, or perhaps not even yet in university, when the events of 2007 and 2008 took place. So let me remind you how close the United States was and how close the world was to a financial meltdown and a very, very severe, perhaps depression-like economic outcome. I joined the Federal Reserve in March of 2007. Among the financially sophisticated, that usually evokes a chuckle. That is, I arrived just before the veritable stuff hit the fan. And my close friends see cause and effect there. They blame me for the financial crisis and the worst recession in 50 years. The beginning of 2007 was relatively benign, and I was at the early meetings of the Federal Open Market Committee. We thought the economy was sailing ahead. In mid-year 2007, we began to see a bit of unraveling in what we believed was a small, somewhat confined market of subprime mortgage-backed securities. And then as the year developed, it was not always perfectly clear whether this was going to be a small event, a small skirmish, or whether it was likely to be something that was deeper and more profound in its impact. But as we got into 2008, it was clear that the Federal Reserve, the Treasury, that would have been Jack Lew's predecessor, and Congress as well, were dealing with something that was somewhat unprecedented. So the deep financial crisis and recession and the slow recovery gave rise to what amounts to almost a decade of extraordinary monetary policy. And let me characterize what that was all about. When I joined the Fed in March of 2007, the policy rate was 5.5%. By December of 2008, it was zero. It was effectively zero. So the Open Market Committee marched down the policy rate from over 5% to zero in less than 18 months. Once you hit zero and you feel that the economy requires more stimulus, you have to resort to what are truly extraordinary policies. And starting in 2009, we undertook 3 rounds of quantitative easing, amounting to purchases of $3.8 trillion. I may misspeak, by the way, during this presentation. It's hard for me to say trillion. Jack will remember there was a politician named Everett Dirksen in the United States who said, a billion here, a billion there. Once you start using the term billion, it really amounts to real money. Now we use the term trillion, and it's hard to wrap your thinking around that. The balance sheet of the central bank grew from about $800 or $900 billion in 2007 to $4.7 trillion at its peak as a result of 3 rounds of quantitative easing. There was also a policy that was between the second and the third round that was called Operation Twist, and that policy was designed to change the maturity structure of the balance sheet, the asset side of the balance sheet of the Fed. But the key point is the central bank's balance sheet grew to over $4.5 or $6 trillion. So what has been the unwinding to date of this extraordinary policy of 0 interest rates and $3.8 trillion of purchases of securities designed to support both a recovery from recession and what turned out to be a very slow ongoing recovery? There have been 7 policy increases to date. One in 2015, it was my privilege to vote for liftoff in December of 2015, which was the first change in the federal funds rate in over 7 years. So the policy of 0 interest rates stayed in place for the better part of 7 years. 2 in 2016, 3 in 2017, and to date, 2 in 2018. The debate, as you well know, at least for people who are thinking short term about the effect of dollar interest rates on the global economy and on the U.S. economy, is whether we will see 3 or 4 rate increases this year. I will give you my 2 cents worth. Let me caution you. You really shouldn't care what I think. You should care what I think they think. And the they here, of course, is the members of the Federal Open Market Committee. I would expect a rate increase in September. I think the status of the economy, which I'll go into a little bit more in a moment, justifies that. Whether or not there will be a 4th rate increase, I think I will remain somewhat agnostic. I think you can make a case that the economy will justify that. The outlook for the economy will justify a 4th rate increase. And there may be some reasons to take a pause at the December meeting. I think what the committee members will actually do is what they always do, what we always did when I was there, and that is we wait for the data to come in to give us a sense of what the outlook is and make a decision closer to real time. There is no set plan per se. It is the opinion of the members of the committee, and there is a broad sense of the direction of the path of policy, but it's not written in stone as a plan. So I think they will wait till later in the year to see what the data say, and perhaps some of the things that Jack Lew discussed earlier as risks and concerns, see how those things evolve. Now, regarding the balance sheet, as I said, the balance sheet peaked at over $3.7 trillion. To date, there has been runoff of about $180 to $200 billion. In the greater scheme of things, not that much. I checked the size of the balance sheet just a few days ago, so this is dated by a matter of a few days, and it was $4.38 trillion. So we haven't seen yet a sizable shrinking of the balance sheet. But the policy is in train, and I think very importantly, the policy that was laid out in October of last year actually is on track, and it has receded into the background of public and to some extent financial public consciousness, which is exactly what I believe the FOMC really wanted to have happen. They wanted to set the shrinkage of the balance sheet in course and then have it become almost on autopilot. So we have gone through the phases, and by the way, the policy, for those of you who are not following this carefully, is not to sell assets. It is to cease reinvestment of maturing assets. So the first 3 months was 10 billion, then it went to 20 to 30. It will not hit full stride until after October of this year with 50 billion a month. So we should see an acceleration of the shrinkage of the balance sheet. So what is the state of the U.S. economy that allows for continuation of this unwinding, both the raising of interest rates and the shrinking of the balance sheet and the reduction of assets, the treasuries and mortgage-backed securities? Jack Lew covered a great deal of this. I agree entirely with what he said. The current state and outlook for the economy really is quite strong. So the U.S. economy is performing quite well. And I believe the outlook of the Federal Open Market Committee, and certainly my outlook, is that they do not see a recession in the medium term, and they expect a continuation, perhaps with some slowing, but a continuation of both growth and acceptable performance in employment markets as well as inflation over the medium term. So let me give you a couple of ways to gauge how I believe the Fed's Open Market Committee and certainly how I look at the performance of the economy. The first is in terms of the dual mandate of the Federal Reserve. Many of you know, I'm sure, that the Federal Reserve statutorily has a dual mandate. They are to look after maximum employment and low and stable prices, which translates into low inflation. Not every central bank has a dual mandate. Some have only the mandate of controlling inflation. In January of 2012, the committee decided that the definition of low and stable prices is 2%, according to a particular index, over the longer run, at the headline level, which includes both energy prices and food. In reality, when I was there, and I believed my colleagues or former colleagues today look at more of a dashboard of inflation to get a sense of where it is. But inflation has firmed in the last year or so and is very close to 2%, at least according to certain measures. I think importantly, I believe the Fed is comfortable that inflation has approached the objective that we set back in 2012. As regards employment, some of you, I'm sure, followed last week's employment report for the month of June. It is surprising even to see the growth of jobs in the United States. It suggests that there had remained some slack in the economy, slack in the labor force that continues to be teased out by the very, very robust employment environment and the availability of jobs. So we saw another 213,000 jobs created net in the month of June. The unemployment rate ticked up to 4% from 3.8%, the official unemployment rate, but that can at least partially be explained by an increase in participation, which is, in fact, people coming back into the labor force. So on both sides of the Fed's dual mandate, there is a very satisfactory situation today. The outlook is for that to substantially continue. And I believe that the Federal Open Market Committee, and I believe they believe, which is what you should care about, has substantially achieved their dual mandate objectives. That puts the committee into a different phase. The phase going forward is to sustain, not to continue to pursue, but to sustain the conditions that are really quite benign today. Another way of gauging how the Fed views the state of the economy and the outlook is growth. First quarter growth was around 2%. The most recent revision came in just a few days ago at 2%. That may sound somewhat modest. The first quarter, mysteriously for some years, has been weaker than the other quarters of the year. And even with seasonality factored out, we still observed for a number of years a relatively weak first quarter. The second quarter, we have not seen any official numbers yet, but the second quarter is expected to be a rebound and be quite strong, in the neighborhood of 3.5% annualized GDP growth. We've actually seen numbers in recent weeks above that, above 4%. But I think a reasonable assumption is in the mid-threes for GDP growth in the second quarter. So for the first half, quite strong. And the outlook for the second half is certainly not to see that tank in any way. So I would expect that, in fact, 2018 is a year of GDP growth that exceeds the average that we saw over 9 years. As Jack Lew said, we're in the 10th year now of recovery. So over the recovery, the average was a little over 2%. I think 2018 will be better than that. Now, part of that could be fiscal stimulus, that growth. The people who watch the data carefully tell me that they don't see it yet. They don't quite see it yet. So they're not certain that fiscal stimulus has kicked in. And some of the expected spending that was to occur because of fiscal stimulus certainly has not yet shown up in either the business investment or the consumer data. But it could be part of the story. And downside risk to that would be, as we've already discussed, trade and possibly an economy because of fiscal stimulus late in a recovery that actually overheats. I'll talk a little bit more about that in a moment. So how far will the great unwinding go? Another way of putting that is, what's the base case policy path and over what time frame? Well, rate increases are likely if the economy allows and if the outlook at each point of making a rate decision allows to continue to at least the neutral rate of policy rate interest. And, of course, the neutral rate is unobservable, but if you look at the projections of the members of the Federal Open Market Committee, the central tendency of that group is 2.75% to 3%. So we're not all that far today from reaching the neutral rate. Now, their projections also assume that they may go beyond the neutral rate to a net restrictive posture or stance of policy. But I think your starting working assumption should be we will see 4 or 5 more rate increases to get to their assumption of the neutral rate, at which point, who knows, they may pause and try to evaluate whether they have tagged the neutral rate correctly. So I would see 1 and possibly 2 more moves in 2018, possibly 3 in 2019, and I think the important point is the committee will reach what they believe is the neutral rate by late next year or early in 2020. Regarding the balance sheet, much discussion as to what the terminal size of the balance sheet should be, and therefore how far the reversal of quantitative easing, how far the policy of shrinking the balance sheet should go. A reasonable working assumption is the balance sheet will be far larger than it was in 2006 and 2007. As I said earlier, the balance sheet when I began was between 8 and 900 billion US dollars and was substantially all treasuries. Bank reserves were around 50 billion. Federal funds rate was 5.5%. I think a reasonable assumption of where they will stop is $2.5 to $3 trillion. Now there is, again, a debate, I think, within the Federal Reserve as to what the operating framework ought to be going forward, because the balance sheet is going to be one that involves much, much higher bank reserves than the historic system prior to the financial crisis. There are 2 basic ideas. One is to continue to shrink the balance sheet to a much smaller size, over $1 trillion, but closer to what it was in 2006 and 2007, and go back to what is called a corridor system using the federal funds rate and the market for the federal funds rate as the principal tool of setting interest rate policy. The other, and I believe the preferred one, is to live in a world of high bank reserves, a balance sheet of $2.5 to $3 trillion, or maybe more broadly, $2 to $3 trillion, and to continue to use two tools that were developed during the financial crisis and recovery: interest on reserves and reverse repurchase agreements, to bracket the federal funds rate and to operate monetary policy essentially at a level of higher bank reserves. This is a new operating framework. It is the current operating framework, and they believe, I think, on balance, that it's working well. So I would use that as your working assumption. There may be, let me say that the balance sheet, when they reach the terminal state, is likely to be almost entirely U.S. Treasuries. So that would be a return to U.S. Treasuries and the almost total rundown of mortgage-backed securities, agency mortgage-backed securities. However, I do recall discussion, and I would not completely eliminate or ignore the possibility that some small residual portfolio of mortgage-backed securities is kept for operational purposes in order to stay in the market, to understand the market in the event that something happens and they need to resume quantitative easing, including the use of mortgage-backed securities. So let's talk a little bit about what those alternative cases, I've given you pretty much a base case policy path, might in fact look like. Well, first, what are the reasons that the policy rate, the federal funds rate, might accelerate? I will point out that at the most recent press conference that Chairman Jay Powell gave after the June meeting. He announced that starting in 2019, he would be giving press conferences after every meeting. This may seem like a small step, but for those of us who lived this for years and debated communications with the public and the financial markets, it is in fact an important step because it essentially allows for policy action at any meeting. 8 meetings a year. For better or for worse, what had happened over several years is the financial markets began to believe there were only 4 meetings a year that counted, and the other 4 were discussion or planning meetings. By giving press conferences after every meeting, the signal is the Federal Open Market Committee could act at any of the 8 meetings, and that certainly would allow for an acceleration of rate rises if the circumstances called for that. So what might call for that? Well, first I mentioned overheating earlier. I suppose you could have overheating in the absence of inflationary pressures rising dramatically, but an overheated economy might be a precursor to inflationary pressures, and just based on growth rates and other indications of so-called overheating, it's possible that the committee might accelerate the pace of rate increases. The other scenario that is, or the other possibility, of course, is in fact unwanted inflation. I mentioned the inflation objective earlier. Today they are in the zone of desired inflation, rising, but desired inflation. And the committee has emphasized that their tolerance for inflation is symmetric around 2%. So I believe they would continue to accept or to tolerate 2% plus inflation for some period of time, conceivably. After all, we've had years and years of sub 2% inflation. So allowing some inflation above 2% for some period of time might very well be accepted. I often get the question, well, what's the threshold from desired to undesired? How high above 2% is their tolerance? I don't think there's any official answer to this. There are currently 17 individual appetites for inflation above 2%. I'll give you my sense of it, the way I thought about it when I was at the Federal Reserve, and I think some of my colleagues think about it today, and that is 2.5% represents the kind of point at which if you saw persistent inflation above that number, you would at least begin to take some concern. You would begin to be thinking, what we might be seeing here is a new phase of inflationary performance, or a new inflationary phenomenon, and we have to begin to think about taking action against it. But believe me, there is nothing official about 2.5%. I mentioned the outlook for recession. I believe the committee does not see a recession in the medium term. Certainly in the official figures, you do not see any projection of recession. But there is, under the current circumstances, and almost always, the potential of a policy error of some kind. And here's one way a policy error might occur. And that is built into the data-driven approach to central banking that the Federal Open Market Committee follows, is a certain degree of patience to allow monthly and quarterly data to accumulate to validate a particular hypothesis. So it doesn't strike me as inconceivable that there is patience with inflation and inflation numbers, trying to sort out the usual noise of monthly and quarterly data, and they wait too long. In fact, something new in terms of inflationary performance has developed, and they have to effectively put on the brakes quickly. And a rapid change in policy could precipitate some kind of recessionary conditions. Likely, in all probability, something mild, but nonetheless, that could happen. But the key point is, on the horizon today, think in terms of a 3-year horizon, no expectation of recession. Why would someone accelerate balance sheet? Why would they accelerate balance sheet runoff? I do not believe they will resort to asset sales per se. There's a very technical reasons related to asset sales, and that is the accounting of central bank accounting in the United States suggests that when you take a principal loss on a security, you have to charge your capital account. It's not that this is the end of the world in any sense, it's simply the optics of losing the capital account of the central bank because of asset sales. So at least at any large scale, I don't expect asset sales. So an acceleration would simply be to change the policy in terms of runoff, if that allows, given the maturity structure, and to allow that the runoff to occur more rapidly, and that would assume, of course, that there are benign conditions that exist at that time to do that. I don't put a high probability on that scenario. What would cause a slowing or a pause? Jack Lew mentioned the yield curve flatness with the potential of inversion. I think this is very much on the mind of at least certain members of the Federal Open Market Committee today. They are quite concerned about what they see. They keep pushing up short-term rates, and the long rates effectively have stayed, 10-year rate has stayed at below 3%, a little above 3%, call it 3% or a little lower as a median. And with all of the change in policy rate posture, they have not seen a proportionate or an equivalent kind of move in long rates. That could be a reason, conceivably, even later this year, for a pause to consider if there is something they can do or to increase communications around that issue. And an event of financial system instability. Globally, United States could cause a slowing or pause. The important point, in my opinion, is not that there's always potential for some instability. It is the condition of institutions in the financial system, which today is far, far more resilient and far, far stronger than it was in 2006 and 2007. So it's not so much the development of instability. We have seen periods of volatility, of course. It is the conditions of key financial institutions and how they would respond and what danger or vulnerability they would show if there was a financial instability event. As regards rate increases causing a slowing or pause, there are risks building, as has already been mentioned, and I think the evaluation of those risks would be the key consideration in the outlook, which is the basis for a rate decision. So a pausing, slowing, or even reversal is always going to be based on an outlook. So the key thing you should keep in mind is when you begin to pick up a deterioration in outlook for the U.S. economy, that is when the Federal Open Market Committee might change its policy posture. There is a global context, and recently we've read a lot about the concerns about certain emerging markets, the pressure on the rising dollar, of higher interest rates, and the question of liquidity in dollar markets, at least as regards those emerging markets. Here is the way I think about it, and I think the way the Federal Reserve thinks about it. Statutorily, there their responsibility is the U.S. economy. They do not have responsibility for the rest of the world. So the way they think about the global context is the spillover from events around the world back on to the performance of the domestic economy. And if the current outlook plays out, you could have a lot going on globally that is not spilling over adequately to change the position or the posture of the committee. I've discussed future operating frameworks. That is a consideration. Let me just close with this thought. The outlook of the Federal Reserve, and I think a reasonable outlook, is the high level of growth that we're enjoying in 2018 is likely to soften or to slow in 2019 and 2020. The official projections show a gravitation toward the believed long-term potential rate of growth of the U.S. economy. That is around 2% or a little bit lower. So you could go from a year of 3% to 2%. At the same time, the employment markets are below what the committee believes is the natural rate of unemployment. So with that slowing of growth, you actually could see a rising of unemployment. And as I've already mentioned, there is tolerance, symmetric tolerance for inflation that rises above 2%. So the monetary authorities of the United States have to navigate this period, which is optimistic and positive for the medium term, but on all three factors shows a slight loss of momentum. That's a difficult navigation task to perform, and I think that's where they are. In order to achieve that, communication with the public is extremely important, particularly with the financial markets and the financial public, people like yourselves, and an anchoring of expectations with the general public to not expect forever 3.8% unemployment, not expect 2% or less inflation, and not expect 3% or better growth, but to accept something less. With that, I will end. Thank you very much for your attention this morning.